So what's really going on in markets? We keep hearing about bubbles, but actually the bubble in markets is in the debt markets. So let me break it down and explain it to you. So imagine that you've bought the latest box set, Breaking Bad, for example. You've bought it, your friends have bought it, your family have bought it, a lot of people around you are buying it. So, okay, great, you think it's a good investment. But the concern is, what happens when you want to sell it? Well, if all your friends, all your family, and a lot of people around you have it already, they're not going to be interested in buying. And this is the problem that we're seeing in the debt markets. Now, the reason is that investors are worried about interest rates rising. The economy seems to be doing well, and therefore the central banks may start to raise rates when they want to cool down the economy. In this type of environment, investors have moved into short-dated, high-yield bonds because they very quickly repay the money that was lent. Now, that's all fine, but the problem is that since the financial crisis, we've seen the US credit markets double in size, but dealer inventory fall by 2/3. Now, the reason this is important is dealers are somebody that you could be selling your bonds to. And if they're less interested in holding debt, it means that, again, you've got a potential buyer removed from the equation. So it comes to selling, you can't, you have the bonds, people around you have the bonds, you are forced to sell at a deeper and deeper discount. Now, this type of turmoil, as we saw in the financial crisis, the reason this is so important is that turmoil in one market could spread to other markets, and therefore this is a risk to stock markets as well. So if we're going to learn from our past mistakes, then I'd say this: if you want to understand the health of your portfolio, the health of your investments, and what's really going on in stock markets, you need to pay attention to the debt markets. Good luck.